it's not always sunshines and rainbows. We need to be eyes wide open when we're looking at deals. The second money goes hard is the second things are getting taken really seriously. So when it comes to ground up multifamily development, I think we've been experiencing housing recession for the last 3 to 4 years. I think that right now you have a replacement cost problem when it comes to ground up development. And what I mean by that is...
Hey Denver, Chris Lopez today. In your podcast episode, I get Taylor Hazlett with Realberry. He is the Senior Director of Private Capital, and we're going to get into details about how Realberry sources, puts their framework, and funnels all their deals down to allow their portfolio here in Colorado. Good morning, Taylor.
Good morning, Chris. Thanks for having me. I'm excited to be here.
I am too, and I am really excited to jump into details. We had Chad McWhinney on here the other week, and he gave the vision, the big picture. You guys have had many cool projects, successful projects, quite a few different asset classes, which is impressive. And I'm excited to talk to you about just how you funnel it, how you scale it, how you find good deals. Before we do, just a quick reminder for everyone about tell us about Realberry, then tell us about yourself.
Yeah, so Realberry's been in business for the last 35 years. Got their start in northern Colorado. Two brothers, Chad and Troy McWhinney, moved here from Southern California. They actually started a strawberry business that grew from a single stand to a couple dozen, and they used some of those proceeds to purchase a couple of 100 acres in northern Colorado. And over the course of a decade, cobbled together another 2,600 acres. So 3,000 acres. Began developing that in the early 2000s through master plan community, Metro District bond financing, and have grown into a group that's got $3.5 billion under management today, working on really cool projects. Some examples for the folks that are in Colorado would be Union Station, the Dairy Block, Foundry Line Apartments in Rhino. So some really cool landmarks in Colorado.
And then I'd like to tell us about yourself, because one of the things that I was really impressed with Chad, and we talked about scaling the business, scaling all that, and obviously Realberry's a pretty big real estate firm, at least in my eyes, right? Dozens or maybe 50 or 100 employees. I don't know.
Right.
It is big, compared to me. But I was very impressed with how many talent people I meet there, like yourself, and other people I met there. And then also Chad was talking, hey, I go out there and I find specialists who are really good at this. They can do this, 1 or 2 jobs, and it makes everything work together. So I know you're a specialist. Tell us about your background, what you do, and exactly what a Senior Director of Private Capital does.
Yeah, so I've been with the firm now for 7 years. I was a civil engineer actually by degree. I went to school in South Carolina at Clemson University, and I've had a little bit of a serendipitous route into real estate. So I started out in design and construction, worked for a general contractor in Charlotte building apartment deals. That eventually I missed the mountains, moved home, worked for a publicly traded home builder, Century Communities, for 2.5 years, learning land development and land entitlement up and down the Front Range. So as far south as Castle Rock, as far north as, call it, Thornton.
Okay.
So up and down the I-25 corridor, got tons of reps, developed a couple thousand lots with them. But that was a little bit of a narrow window, right? It was land concept through turnover to the home builder, where Century's vertical team would go and take it from there. And through that and through living here growing up, was familiar with the McWhinney company, and which is now Realberry, as we've mentioned. And they have a lot of land holdings. Like I mentioned, 4,000 acres in northern Colorado. I saw a posting for a land development role with the firm and threw my name into the hat. And through a number of rounds of interviews, got the opportunity and started working on the master plan community team. So what that sort of involved was infrastructure, land entitlement, city process. So got to work really closely with the city and county of Broomfield, the city of Loveland, with all of our vertical uses. If we were going to develop a flex industrial building, the infrastructure team was going to support that site, right? They were going to bring utilities to it. They were going to do all the grading. And that sort of was awesome, right? Being able to assess a piece of land, understand if we've got easements running through it, understanding what the topography might mean for that site, having sort of that civil background kind of lent itself to being able to bring a little bit of a different perspective to evaluating real estate opportunities. From there, in 2021, I got the opportunity to join the multifamily team. We had a partner reach out to us out of Texas, where they were going to take down a piece of land fee simple. So we were gonna sell this land to a build to rent developer, and they were gonna go and do BTR and operate it themselves. But because we have all this land development experience and have been through the city process so much, we decided it was a good idea to create a joint venture. And so through a 50-50 co-GP, created a joint venture with this group, American Housing Ventures out of Texas, and we have built close to 400 BTR units. And that's what I worked on for the last 5 years until recently, coming over to the private capital side to help support fundraising initiatives for the firm. So long roundabout way of giving you my background there, but I think that probably covers it.
No, that's great. I actually want to ask you about kind of BTR as a whole in Colorado, right? Because I don't see many BTR developments. The vertical apartment buildings downtown, they're not BTR, but like there's, I see very few. I know you guys have done a handful of them, but everything I've looked at, like, land's high, water cost is high, regulations high. Like, talk about the BTR scene in Colorado, because I've seen a lot more deals outside Colorado than here in Colorado.
Absolutely. I mean, you go look at places like Texas or Arizona, and you've got BTR just, all over the place. And we've looked at this. We think Colorado is a super underserved market when it comes to BTR. And I think a little bit of that is some of these markets like Texas have found ways to be able to build it through using a singular GC. Whereas in Colorado, because of the way that the home builder market is sort of structured, we have to bifurcate that work. So we hire a land development GC that breaks out what utilities, grading, concrete, asphalt, and then you also have to hire the home builder. So there's complexities in how we structure this stuff.
And this is different than other markets.
It is, right?
Okay.
So for whatever reason, the cost to build in Texas is a little bit less than it is here, and so people are able to make it pencil by using a group that subs out the wet utilities. Where here we're forced to almost GC the job as the sponsor. There's only, I want to say, between 30 and 40 active BTR deals, which is just mind-blowing, right?
You mean in all of Colorado?
In all of Colorado.
And what is your definition of BTR?
I would say that would be single-family detached, duplex, or townhomes that are purpose-built, amenitized. They don't have to be amenitized. I think you probably see 50-50, but the entire community is purpose-built for rental.
Okay. And there's about 30 or 40 of them in Colorado.
Right.
And to me, that just seems incredibly low.
It's really low.
What about, and this is, for BTR and just in general, like water tap fees? I've invested in deals. I've talked to many friends, and all I hear are four-letter words and dollar signs with water tap fees.
No, it's gotten crazy. I would say that water rights, having them, period, is a challenge, right? That's one of the first things that we look at when we're evaluating a site is, do they have water or a path to receiving those water rights? And then in addition to that, how much do those water rights cost, right? And I can't speak to each municipality specifically, but we have a number here that'll blow your mind if you go in to look to see how much water and sewer tap fees cost.
Is it? I've heard like $50,000
between the two of them. You can be up to 50. I'd say $30,000 to $50,000.
Yeah.
And you have certain municipalities that are trying to pass the buck to the developer in terms of, call it a traffic impact fee or an infrastructure fee, where because you're bringing more daily trips to that community, you're going to be responsible for funding that infrastructure, and that could be $15,000 per home that you're paying in impact fees, right? So, yeah.
So that's part of the reason why you just don't see them, because the margin's harder.
It's harder.
Okay.
It's a lot harder. And there was a time when the BTR developers could compete with for sale home builders, but that was when rates were zero, right? The second interest rates went north of, when the Fed raised their rates to 5.25%, that really took the competitive advantage away from all of the home builders that were trying to do BTR.
Okay. I want to shift over to like your deal funnel or the framework for how you evaluate deals. You briefly mentioned with, water tap fees and water sourcing is part of it, but But taking a step back from that, because I'm always fascinated how group source deals just kind of, hey, what's the big picture funnel? Like, how do you establish the buy box? How many deals are coming in? Kind of what are the major milestones or steps down below? And then ultimately, like, what spits out the bottom, right? Hey, look at 100 deals. Hey, maybe there's 2 you
Right.
buy. Or I love learning about those ratios and all your criteria in there. So can you start from like the top and big picture, then work to the bottom?
Yeah, I think the first thing I'll say is, if you're a passive real estate investor and you're deciding between a handful of opportunities, understanding what it takes to get there is interesting, right? For our group in particular, you mentioned 100 deals. Like, I think that's a great example. We may look at 100 before we get to 2 or 3 that we'll eventually close. And we have certain processes in place where we can say no really quickly, right? I think I'll give you an example. So if we're trying to build in a first ring suburb and we're trying to build
first ring.
First ring. Think 470 loop.
Okay.
Anywhere within 5 to 10 miles of the urban core.
Okay.
If we're going to go try and build a suburban multifamily deal, so I'll just give you high level numbers here. If we know that it's going to cost $220,000 per unit, leave aside impact fees, leave aside water rights, leave aside land acquisitions. We'll keep this really high level. Generally, we know that we're going to need anywhere from $2.40 rents to 245 rents.
Per square foot.
Per square foot.
Okay.
And so that can eliminate a number of markets from being considered. So I might see a deal come in from a certain municipality, and I know that I don't get rents that can justify that cost to build, and so I can eliminate half of what's coming in immediately. Now, if something, and especially in a market like today where we're experiencing a lot of softness, right? Denver specifically has been in the headlines a lot, right? With like other places like Austin, where we built so many units, and that's across any asset class, really, from the highest density multifamily to the BTR we're talking about. We've built so many units that the softness is making it so that it's really hard to find those communities that justify the rents. And so when we go from 100 deals and now all of a sudden we've eliminated, say, we'll call it 60% of those just with our thumb.
Just
right?
like the 3-minute.
Yeah, it's like, do
dig in or delete
work?
type test?
Exactly,
Okay.
right? We have certain markets that because we study this so much, we know where we want to be, right? We love, places like Willard County. It's a really fast growing market. Douglas County is always up there with, some of the top places to live in the country. And so we can high level eliminate a lot of places to build. Yeah. From there, if we think something's interesting, we'll take it through our investment committee with a 5-page teaser. This is, we're calling this our initial screening, where we'll get immediate feedback from our C-suite and our investment committee.
Who sits on the investment committee?
This would be, your chief investment officer. This would be both of our founders. This would be the head of your debt capital markets team. This would be asset management's head or chief legal counsel. So we've got, call it anywhere from 5 to 6 people on that investment advisory committee that sort of, shepherds us through looking at deals. So
and how often does that committee meet?
every Monday.
Every month. Okay,
Every
so
Monday.
that's like, okay.
Yeah, it's really consistent. We have certain milestones within the development timeline where we do go and meet with investment committee, right? It's that first
After it's closed. you're
after
just
that's
doing
closed
more
and
like-
before. So when we go for this initial screening, we're going through investment committee. It's we'll call it 15 to 30 minutes.
And this is still just, hey, should we dig in more?
Should we dig in more?
Okay.
Right. And so
Because all the key players looking and saying, yeah, no red flags for me.
exactly.
We
love this
blow it
market.
up.
Go
Okay.
ahead. Now we went from 100 to call it 40. After the screening, you might be at 10.
Oh, okay. So,
Right, so this is
investment
further
committee
elimination.
kills them a lot.
Yeah.
Is there like a certain person or a certain area especially on there that kills more deals than the other? Is there like, oh, if we get it past this guy,
Yeah.
and maybe you can't say on the podcast.
Yeah,
but
I know.
like,
No,
I'm
there's-
envisioning Shark Tank, right?
Yeah, we certainly have a couple of investment committee members that are really good at asking questions. I'll say that.
That's what you want, though. You
That
want the
is
people like,
100%,
Yeah.
right? We need to.
This is why we're not going to do it.
It's not always sunshines and rainbows, right? So we need to be eyes wide open when we're looking at deals. The second money goes hard is the second things are getting taken really seriously. So the litmus test for taking things a step further with that initial screening is that that's not something that's really hard to get through. But the second that we start putting investor capital or internal capital, to play, that's when it becomes real, right?
So you said it sounds like, I think we're using the fictitious 100 numbers. Hey, it goes from 40 to 10 deals in investment committee. So it's about 75% of the investment committee will say no to. Is that
initial screening?
Yeah. Okay. And after that,
the deal falls apart at some level through that process, right?
What's the next step after the investment committee? Let's just say everyone says, "Hey, thumbs up, move forward." Are you doing like the deep DD? Are you putting down an LOI? Like, what's the next step?
This is where we'd come to that LOI stage, right? So you've gone from 100 to 40 to 10, call it. Now we submit an LOI, and now we're in a competitive process in many cases, right? So now you got to go win the deal, right? And if we get into a competitive bidding process where we start to get to a point where we can't justify that land price anymore, that's where you go from 10 down to 3, 2 potentially, right? So it's that LOI process. Sometimes we find off-market opportunities where it's, not run through a brokerage firm, but oftentimes, those are the guys that are spending every day going to find deals.
Oh, yeah.
And so in a lot of markets, that's how you go and find places to build.
Okay, so 10 make it through the investment committee, starts out on LOIs.
Yep.
A lot just fall apart through normal deal negotiation. Or, hey, I don't know how you're going to pay that much for that per square foot, but we're out, right? Like,
right. Exactly.
Do you have any rules? I've talked to a couple investors, and they're like, if I ever get in a bidding war, it's an automatic no. Mm-hmm. And I feel like very few people 100% rule because it's hard to. But do you have rules? Hey, if there's a certain number of bidders, or if we're not the only player at the table, or is it simply, hey, if we go above this number, we're out?
Yeah, I would say that it's deal dependent. I think nobody loves paying over market for land. And so you start to get into a place where, and we'll get to this a little bit when we talk about our financial underwriting.
Yeah.
We build in sensitivities where we don't want to be in a situation where the stars have to align for us to have a successful outcome. And so when we build in sensitivities where if we experience a little bit of softness in the market, what does that look like, right? We have higher vacancies. Mm-hmm. When we look at a cost, right? If we were going to be paying $10 a foot, does the deal still work at $12 a foot? If not, we're out, right? It's really important. The deals that you do get are important, but sometimes the more important deals are the ones you don't, right?
Okay.
So you got to keep your ego out of it because people they want it to work, right? And so that you get it sort of an attachment because you take it personally and you want to do deals, right? That's why we're all in this business. But a lot of times it takes a look in the mirror to kind of know that.
Can you elaborate on just the discipline of saying no? Because that is one of those things easier said than done.
Totally.
And many people, 4, 5, 6 years ago, people kind of stopped ignoring their rules or a little wiggle room. And,
For sure.
Numbers fudge. Hey, we'll fudge our numbers, right?
Right.
How do you stay true to that as an organization?
The way that I think about it personally, and I think the way that we think about it as a group is we are data-driven decision makers. So if the data doesn't support the thesis, then that's a huge red flag, right? And so if we rely on that as just sort of a North Star, I think that compels us to make some better decisions.
Okay. Random question for the investment committee: does it have to be a unanimous yes or simple majority, or hey, if one person says no, they blow it up? What are those dynamics like?
Yeah, I would say that it has flowed through the years. We've had majority rules before. Investment committee has been an advisory committee before, where the founders have the ultimate say. Yeah. And so I think it's more often than not everybody gets to the same page, right? Now you have meaningful, deliberate conversations in these, right, where somebody needs to get their head wrapped around what we're trying to do. But I think at the end of the day, everybody's lockstep by the time we're getting to a place where we need to make a decision.
All right, so I think we're kind of done the high level of the funnel, right? So about 100 deals, maybe 1 or 2 will come out at the end where, hey, you buy it, you put together OM, throw the GP capital, investor
Right.
capital in there. Okay, so 1 or 2% ratio, which is I say pretty typical. And as far as like your deal flow, it sounds like most are coming from brokers, right?
Yeah, I would say that it's a mixed bag. I think like I mentioned, the brokerage firms do this every day.
Oh,
right?
that's your
So
full-time job.
these guys are out there. One of the things that we like to, because of the history of the firm, one of the things you'll see just is inbound opportunities that are not brokered. So, somebody knows Troy McWhinney or somebody knows our chief development officer, and they're like, oh, this deal might make sense for you guys. So, we do see, I probably would say 25% of our opportunities, if not a little bit more, come from inbound.
And most of that's just brand.
It's brand. It's history here, right?
Dude, that's a solid inbound lead flow.
It totally is, and it's a little bit surprising, right? Like, but the thing is when I don't know how many other people here are like us, right? 35 years doing this. The relationships that people, and it's not only the relationships of the people that have been there forever, it's the relationships that people that come, it's a great place to work, and, it attracts really strong talent. And so, I can give you an example here where we may look at something, we have land development partners out there that don't typically use brokerages. When you look at some of these publicly traded home builders, they go to the same, 3 or 4 usual suspects that go out and take risk on unentitled raw land. They go in and they paper the lots. Maybe they leave a multifamily parcel, and we have some of those relationships where we can go and find something, and maybe that land development group, he or she is almost acting as a broker themselves, but they'll take it to a smaller group of people.
Yeah.
So that's just an example of what that might look like, or a deal of an investor of ours that is a little bit more sophisticated, that may know somebody that owns a piece of land. So we're always listening and looking at those.
I mean, after 35 years, I'm sure your LPs some are active, and then they all
Totally
know someone that makes sense for referral sources.
Yeah.
All right, so about 25% organic inbound, 75% through brokerage network. They come with your deal funnel on here. They work through it. Do they have about the same ratios? If 100 broker deals come through versus 100 inbound leads, are they about the same ratio, or would you say is one a higher quality source or less quality source?
I would say generally when it's a brokered process, you're going to see a little bit more competition, right? I think ultimately you're going to try.
Yeah, they got to shop it around.
Exactly, right? And so I would say that one is not better than the other. Maybe you're dealing with less competition at the end of the day, but I think both get to the highest and best use for that piece of land and get to the dollar figure that works for the investment, right?
Okay.
It's all just a math equation at the end of the day.
Yeah. Talk to me about the underwriting process. So it sounds like the heavy underwriting comes in before the first investment committee, or after. Like, what can you walk through? Like, hey, when you do that 5-page memo to the investment committee, like, what type of underwriting model is attached to it? Is this like the 1-pager executive Excel spreadsheet, or is there a 20-tab model built out?
So we use the same pro forma for if we're looking at something that's really conceptual, or if it's super detailed.
Okay.
Now, the substantiation, that's what you dial in as you get further and further down the process, right? Just like when we're going to design a project, you go from concept to schematic design to design development to construction drawings. At each level through the design process, you have more details to price, right?
Yep.
So when you start a deal in concept, that's as simple as, hey, one of our construction managers may call 3 to 5 of his GC buddies and say, hey, this is the product type we're trying to build here. We don't want to exercise these guys to a point where it's, these guys are spending 2 weeks to go underwrite a back of napkin sketch, right? So we need just general ballpark GC pricing when we're in the concept phase, right? Okay. We haven't spent any money yet. We haven't started drawing anything. And so it's really high level. When it comes to hard costs, we're going to underwrite what the land guidance is, whether it's that broker or that landowner that we know separately, right? So that much we know. We can go and do a lot of detailed diligence on impact fees and on water rights, right? So we do get into some of the weeds in those early phases of negotiation, because we can. But when the deal hasn't been designed at all, that's where we're pretty high level, right? So we'll go do market studies where we're looking at CoStar, or we're looking at a deal nearby that we own, and we're comparing current in-place market rents. And so we do a lot of detail there.
Okay. And then for these market studies, is the combination like using third-party reports like the Zondas, the CoStars, and your own house stuff, or do you have like a completely third-party process, or what's that look like?
Yeah, so it's a combination of both. So we'll use AI in certain times where Hello Data is a platform that's gotten pretty popular, that's able to narrow, within a certain mile radius, we can look at rents over the last 12 months. We do third-party market studies. When we get to a place where we're really serious about a deal and we want justification, we go to third parties. Additionally, when and this is unique to us maybe, but when you have a Loveland 300 acre master plan and you have an 1,100 acre master plan, we've already built multi on some of those, and so we do know a little bit more than maybe our competitors do, right?
Okay. And so when you're underwriting these deals, talk to me about the variables and what type of sensitivity analyses that you will do in there. Because, hey, a lot of people 5 years ago, right, everything that was cheap, rents were just always going up 8% a year, of course. And, hey, one thing changes survives, but now, hey, rates doubled, rents went down, rents went down, expenses are up, right? Everything changed like the wrong direction, the sensitivity analysis. And as you know, a lot of people are hurting now.
Yeah.
Talk to us about like the guardrails you'll put in place and how much of that pendulum you'll underwrite to, hey, optimistic versus what we think versus, hey, if things go bad, this is where we're sitting.
Yeah, so we have sensitivities around just about one would be cap rates, one would be rents, one would be occupancy. So what we're doing is we're constantly tinkering with what happens if we experience the softness that we really just did, right? What happens when rents are down 10% year over year? What happens when a lot of this is ground up development. Yeah. But when we look at an existing acquisition and we're doing a value add deal where we're going to go in and we're going to replace countertops and cabinets and paint, what happens when those units aren't leasing as well? Can we cover the debt service if we don't do anything to the deal, right? We're looking at, hey, what could go wrong here, just so that we don't put ourselves in a situation that we don't want to be in.
Do you do like, hey, what if all three? Hey, what if this goes bad? This goes bad. Because one of the things that I became better as I was evaluating deals is just like not taking the variables in isolation. But hey, what if everything goes bad? Right? Like how do you do like that where, hey, all the variables swing one way or the other?
Yeah. So we'll have a base case. We'll have a downside scenario, and we'll have an outperforming scenario. Okay. Right. So the downside scenario is just what you described. It's like worst case scenario. What does this look like? Right. The base case is, hey, this is largely where we think we're going to land, and then the upside is, hey, what happens if we see outsized rent growth in this market?
How? From a high level, like how, especially for Colorado, like I think the Colorado market got hit harder than a lot of people expected, right? Hey, with the oversupply, population slowed down, our insurance costs got up dramatically. Legislation has not and helped us, on the front. Like, hey, looking back 5 years and saying, hey, worst case scenarios, I think we're a lot of times kind of like in the worst case for Colorado. Right. How has your general underwriting held up to that when, we've just gotten a lot of kicks and punches last few years?
Yeah, I would say it's been pretty durable. I think certain asset classes have been, and this is not unique to Realberry. I think this is across the market. Certain asset classes have been impacted more than others. I think that those downside scenarios through this more recent downturn, and we'll call it's two things, right? It's the sudden rate increases plus the oversupply that was really tied to having low interest rates for such a long period of time. I would say that we have to get really sharp when that sort of stuff is going down, right? Because for a decade plus, you didn't have to be that sharp and to be successful. And now we need substantiation, line item by line item. When we get to a place where we're getting ready to execute and we're going to go capitalize the deal, I need to know what the perm policy on my insurance is. I need to have backup for my builder's risk and OSIP insurance. I need to have market studies that support the rents. I need to have an operating budget from whoever my operator is to justify the payroll. So, we're talking about every line item within the pro forma, and we're talking about discipline across the entire model.
Wow. Okay. I got a random question, so I want to kind of loop back. You're saying no to a lot of deals. You see a lot of stuff. You got 35 years. You have a lot of institutional knowledge, right, with just the team and the processes and all this. Like, are there common trends you see in deals or interactions, negotiations with sellers that are like an instant red flag where, hey, to the average person or us 20 years ago, now we see this, we know this is just, we walk away from it, right? This just has a little too much crazy on there, or we don't want to touch it. Like, have you kind of learned some very nuanced things where it's like, hey, that's toxic, we don't want it?
Yeah.
Maybe not toxic, but we just don't want to touch it.
Yeah, I think we obviously like to do business with folks that we know. I think that I can't really point to a specific red flag that I've seen. Obviously, you have things either are going to work for us or they aren't in certain respects, right? And so when we're looking at a new opportunity to go develop or to go acquire, I think we know pretty quickly if it's for us, right? Whether it's from a brand perspective, from an underwriting perspective. I think instead of relying on, it's almost an internal look, right? Rather than judging the opportunity based on who's brought it to us or what might be within it.
Okay. What's your read on today's market? And really specifically, like, we can talk a little bit of macro, but really like Colorado, right? Like, we're all Colorado. You live here, doing a bunch of deals here. And then, most of us invest here in Colorado.
Yeah.
And I'm very curious, like, just kind of, hey, where you think we are and, where's the puck going, so to speak?
Yeah, that's a really good question. My perspective is, at least I've been pointing to ground up multifamily development a lot, and I think this is a good place to drill in a little bit. So when it comes to ground up multifamily development, I think we've been experiencing a housing recession for the last 3 to 4 years.
Yep.
I think that we have seen, and this has shown up in a lot of the data, right? We've seen year over year rent declines across a lot of the Denver MSA, some submarkets better than others, some worse than others. I think that right now you have a replacement cost problem when it comes to ground up development. And what I mean by that is we are probably on average, call it 20 to 30% short. So if I can go buy something for, call it $300,000 per unit, and it would cost me $400,000 to build it, it's really hard to get capital behind building new.
Yeah.
Right. And so I think
go buy it.
Exactly. And so you've got, a wave of loan maturities out there where you have sponsors that are still on construction loans that, maybe can't justify refining because they could be in a cash out refi situation. I think there's a lot of opportunity in the existing acquisition space.
Where do you think we are? Because I have definitely, talking multifamily, I've called the bottom early every time last couple of years. I realized that I've caught a few falling knives, so to speak, in some deals and all that, like, and I go back and forth between, hey, like, supply is burning off.
Yep.
And I think we've kind of maybe peaked there this last, early this year, end of last year.
Yep.
But also, when does this extend and pretend wave stop? Because I'm like, hey, supply's kind of, I think, peaked. The wave is still cresting, but extended to pretend. Like, when does that happen, and how do those forces hit each other? And then are we going to see prices drop more, or do you think we're kind of at the bomb-ish, or kind of what's your best crystal ball guess right now?
Yeah, I think the latest data that we sort of analyzed was that the rate of the declines were starting to slow. Maybe we're not at the bottom of the trough, but we're starting to see
price declines slowing.
Price declines,
okay.
And maybe we're talking about rent specifically, right? I think construction pricing has stayed around the same for the last 3 to 4 years. Like we've seen a little bit of a tick down. I mean, we're talking about it, and I gave that example earlier on the 3-story garden style stuff. Maybe it was $220,000 per home or per unit 3 years ago. Today it's 220 still, or it's 219. So we haven't seen much relief.
And
on
that's
the construction
labor
side.
and materials.
Exactly.
Because that's after everything spiked up during
Exactly.
COVID and the tariff stuff.
That's the combination of those. I would say, and to get back to your question, I think that we haven't completely bottomed out, but we're starting to see green shoots, right? I can tell you anecdotally on some of the deals that I've worked on, we are starting to see concessions burn off a little bit. I can speak to our baseline.
You mean rent concessions?
Yes, yes, rent concessions. Sorry. We've got a 142 unit townhome deal in Broomfield that 3 months ago was offering 8 weeks free, and today it's offering 4 weeks on one unit type and 2 weeks on another unit type.
Oh,
so
wow.
So
those are dramatically decreased.
You're starting to see that. And I think that's all good.
Are you seeing that in your vertical multifamily?
We are. Just across the street from that property, we have another one, and maybe it's not to the same level, but it was offering 10 and now it's offering 6.
Okay.
Right. So, and you're starting to see some of these communities that maybe were 95% occupied and crushing it in 2020, 21, and then experienced some softness where they were really hovering in that 88 to 91% occupancy. Some of those are starting to get back to a place where they're, let's call it 95% leased and 93% occupied. And so some of these, everybody was really fighting for these renewals, right? You don't want people, you want to keep heads in beds. And so if you take a microscope and you're looking at some of this data, I think you're starting to see some of the recovery starting to happen. And it's not showing up in the rents today, but it's showing up in anecdotal pieces on well-located assets where those rent concessions are maybe starting to drop.
All right, so rents, concessions are dropping, so therefore maybe in a year or two rents start going up.
Mm-hmm.
It sounds like construction, labor materials have been flat.
Yep.
I mean, do you expect those to go down, stay the same, up? And then what about like insurance, right? Insurance was the other thing that hurt a lot of people. I've had a few deals where insurance has gone down.
Yeah.
I've had a few deals where insurance has gone up as well.
Yeah.
But at least it's not everything's going up. Like, what's your read on some of those like major like expense items?
Yeah, I would say starting with the construction side, until we see, I think a lot of it's a supply and demand formula where we have a lot of contractors out there today that are hungry for work. And so whether the materials or the labor has gotten more or less expensive, maybe beside the point, but the fees and the margin that these folks are having to get comfortable with just to keep themselves busy and the lights on is going to keep construction costs relatively flat. Maybe they increase with CPI or track close to it, but I would say generally I don't think we're going to see a supply chain issue like we saw post-COVID, where we saw hard costs increase by 25 to 30%. And
you think the biggest reason is just because, work is short, so everyone's just lowering their fees and working on thinner margins just to keep lights on?
Exactly.
Is that like, okay.
Right. And I think that trickles down the chain, right? That starts at the supplier, the manufacturer, right? They're having to get tighter, and then the sub's getting tighter, and the GC's getting tighter.
What about insurance?
On the insurance side of things, I think that's one of the places that we have seen some relief. And I think that extends both on the builder's risk side and on the OSIP, CSIP side. So, and then in addition to that, on master policies. And I think a little bit of that is because of it's almost the same idea as the construction pricing. A lot of these carriers and brokerage firms have way more to look at now, and they're having to start to get competitive and sharpen their pencil to get these policies.
Yeah.
So,
all right, so that's good news.
Right.
What about other major expenses or items? Any other like things where you can help forecast NOI?
Yeah, I think it's a good question. I think the rest of it is sort of around the margin. I think taxes is a place where people try to get really creative. I think a lot of that is a component of, look, we've had values in assets that have been declining over. This just shows up in cap rates. It shows up in the numbers, right? And so if my make-believe deal was worth $100 million 4 years ago and today it's worth 90, I should be paying less taxes on that. And so we're really holding our tax consultants accountable, and we're pushing back and we're appealing some of the assessors some of their information.
Yep.
So that's another place it can show up if you're sharp and you know where to push.
Okay. If possible, I'd like to talk about, because I know you guys are doing like a BTR deal down in Castle Rock.
Yep.
And just high level, what you can talk about it.
Yeah.
Because from my understanding, you're not developing it, but you're buying it, and it sounds like a good base. It sounds like it kind of ties into a lot of like the buy box you guys had, these market dynamics we talked about. Can you take all the conceptual stuff then connect the dot to a real deal?
Yeah, absolutely. So the deal we're discussing here is a 60-unit townhome deal down in Castle Rock, and this was a really unique opportunity because it was sort of a mark-to-market opportunity. And when I say that, I mean the deal itself was not professionally managed, so it was a mom and pop. And so when we looked at the opportunity, it's the rents that were in place were significantly below the market, which made us investigate it further, right? So because we've built almost 400 BTR units in the last 4 or 5 years, we have a pretty good gauge on what it costs to replace this stuff. So it checked the box on the replacement cost side of things.
Like able to buy below replacement cost?
Exactly. So that was a key. I mean, I think that's a really good feather in your cap, right?
Yep.
It's like, and how long is it going to take to get there too, right? If you hold on to this thing for 3 years, is it still below replacement cost, right? So I mentioned mark-to-market opportunity where you're sort of looking at lease trade-outs where call it 20 to 30% without touching the unit, and then call it another 20 to 30%. I'm making up these numbers, right?
Right.
If you improve the unit and get it back to market. And so with the basis, with the micro location, and we were talking about this before we were on air a little bit, but when we look at submarkets and we look at micro locations within submarkets, it matters the corner that your property sits on, right? We talked about 2 deals that are 500 feet away from each other could have wildly different performances. And so we love the micro location on this deal. And so it went through the same process that we kind of discussed, where it meets the business plan, right? We want more exposure to build to rent. There's an affordability crisis in this country on the for sale side, right?
Yep.
And people are looking towards places like BTR to fill that need. Additionally, Castle Rock is number one, or it has been close to number one on U.S. News top places to live in the country. And so it's an amalgamation of factors here, but all of those led to it being something that we would really consider, and a group that we have historically never really done much multifamily acquisitions. This was a great place to start, right? We have developed multifamily from the ground up perspective for a very long time.
Wow.
And we on the hospitality side, we have developed and acquired hotels. So we want to be diverse in how we're thinking about things. We want to be looking at new opportunities, whether it's ground up or acquisitions.
I want to talk within this context here about the quality asset. It seems from the looking at the website, talking to people, Realberry really focuses on Class A type assets.
Mm-hmm.
I've done a lot of investing in ground up development BTR outside Colorado, in the Texas markets and then those other markets. I've also done a lot of vertical multifamily value add, and I'll say pretty typical, but they're like Class C buildings, right?
Sure.
I've done a lot of multifamily Class C. The BTR developments, those are Class A type stuff. But for me as an investor and other investors out there, I think most are familiar with that Class C multifamily value add, right?
Sure.
And I'm trying to wrap my head around the risk reward on that, right? Because Class C is definitely having a harder moment now than than Class B, Class A multifamily. And then I don't know how to get an idea about how can I rate a Class A risk reward? hey, Castle Rock, I live in Highlands Ranch. I love Douglas County.
Yeah.
I've never invested in Douglas County because it's too expensive, right? Like I can buy a unit, then rents don't cover the debt service.
Right.
Not a good rental for a landlord. But I love the market. It's a Class A market. Castle Rock, I go down there for, happy hours in the parks and all that with the family. How do you look at risk reward on the Class A stuff and risk reward on the Class C stuff? And is it a fair thing that you guys focus most on Class A?
I would say that we're.
I don't want to put words in your guys'
No, I think that historically we have done more Class A development. I would say we're class agnostic when it comes to evaluating opportunities, right?
Okay.
I think we would look at 70s, 80s, 90s vintage stuff. I think to your point on, some of the current headwinds that are facing the Class C market rate multifamily stuff, it has to do with, this is a good problem to have for society, but it's a bad problem to have if you're a passive investor or if you're an investor in real estate, because you're now in a place where you have LIHTC deals that are, lower income housing tax credit deals that are competing directly with market rate deals.
Yep.
Right. And so you have situations where you're experiencing some softness on the Class A stuff. When you build new ultra luxury apartments and you've flooded the market with supply, you have a lot of people moving up within that, right? And you get this sort of trickle down economic impact. And so a lot of the Class C stuff has been disproportionately impacted because of this, right? If you were in a Class C apartment and it's going to cost you the same or less to go into a Class B apartment,
I'm gonna upgrade.
I'm going to do that, right?
Yeah.
And you have a lot of concession hoppers and whatnot. So I think the Class C market has been disproportionately impacted. I can't speak to the exact numbers, but I've seen, more than 10% year-over-year rent declines in that space. So it's definitely experienced some softness. Now, with that, maybe there's opportunity there, right? That's why I come to because when you're looking at an in-place cap rate, this is where you go and find mark-to-market opportunities.
It doesn't really matter for value add, though, right? In-place cap rate. I mean,
Well, right. Well, yeah, maybe you're looking at something that's a 3 to 3.5% in-place cap rate, but you've got, that we talked about Red Hawk as the example where it's not professionally operated.
So it's probably a low cap rate because you're probably going to have low basis. It's
but
what
would it actually be
if
it
does not look good?
Exactly. What would it be if we were operating it today?
Yeah.
Right. So
is it going cap rate what? High 4s, low 5s for Castle Rock for?
It's I don't think I can speak to exactly because I didn't work on the deal myself.
Okay.
I think it's in that range.
Okay.
Yeah.
And I'm just kind of curious about I haven't seen a CoStar report for Castle Rock, on that multifamily scene. All right, Taylor, this has been a really fun podcast so far. I have 2 more questions I'm going to squeeze in here that are just kind of little ones out of my curiosity.
Mm-hmm.
You mentioned water rights a few times.
Yeah.
And I am, I'm from the East Coast. I am intrigued and confused by the water rights system out in the West.
Yeah.
But it's so fascinating how it impacts everything, and it's the root. How do you evaluate it? What are the costs? How do you find water, buy water? How?
This was,
or should this be podcast number 2?
I was going to say you need to call Chad McWhinney and Troy McWhinney back into the room because those guys have dealt with this for 35 years.
Okay.
I would say that you sort of, when it comes to water rights, it is what it is, right? So it's certain municipalities are really strapped for water rights. In others, it's really expensive, and it's a finite resource, really. And so it's knowing where the city has a lot of say in how that's kind of parsed out. And so when we're going to look at a deal, and it doesn't have water rights, there are certain avenues for which we can go and find water rights, right? Certain owners of real estate happen to have more water rights than they need.
Yep.
And if you know that person and you know a site that doesn't have water rights that are specifically tied to it, you may be able to go purchase those from a third party. A lot of times the water and sanitation district has an eyeball on where it is, or if it's the town of Castle Rock, or you name it. So it's convoluted. You could write a 500-page novel on the history of water rights in Colorado. I mean, you've got places where, Thornton was a place that was almost impossible to build up until recently because there was a water line that was going to be coming from up near Fort Collins that needed to supply water to Thornton. And getting that water there was the long pole in the tent. And so they finally solved this problem, but you've got water rights in completely different geographic locations that are tied to certain areas. And that may be an oversimplification, but it is a convoluted mess. And, the people that understand it get rewarded for it.
Okay. I have so many questions. That'll be podcast part 2 on there.
Yeah.
The last question is I want to talk about, from a high level, and I'll butcher the name, but the 21st Century, Road to Housing Act. I think I got that close. There's a lot of stuff at the federal level.
Yep.
And in the early phases of the bill, there was a lot of stuff that had BTR developers and investors very scared. I think it's not panned out the way it originally was, but can you talk from a high level, like your thoughts on the bill? I know there's still like a 6-month period on they have to like figure out some details and how that may impact your guys' projects or just the industry in general.
Yeah, so I can talk to it from a very high level. I think when the Senate proposed the bill, I think the initial language in there made BTR developers very nervous because it was specifically called out.
Yeah.
There was stipulations along hold period where, how it put capital completely on the sidelines when it comes to BTR development or BTR acquisitions, right? So it's like you're sitting there and it's like, I have to sell this thing in 7 years. That's not a business plan that anybody wants to sign up to, right? I think, they were really trying to nail down on institutional investment into single family rentals,
like mostly scattered site, right?
Exactly.
Yeah.
And I have personal opinions on how that works. I think there's a time and a place for institutional investment into single family rentals, and I think that one of the things that most people don't know is when you look at the percentage of the overall housing stock that is actually institutional owners, it is such a small amount that it's almost like, why are we focused here, sort of thing. I think that when it went from the Senate to the House, they cleaned up a lot of these issues. I think BTR development and acquisitions is less threatened than it was. I think that there's going to be a world where that stuff, where those asset classes continue to be built and can thrive.
Okay.
So yeah.
Taylor.
We were nervous about it for a while.
Oh, I had some friends who developers. Like I said, I'm an LP in a few deals. I was nervous. Yeah. I think you guys were really way more nervous than I was, right? Even a lot more than a couple of LP positions like I do in there. Taylor, this has been fantastic. Thank you so much for coming out. Appreciate your time. Appreciate your expertise. And at some point, get you on for part 2 to talk just more things Colorado real estate, man. So thank you very much.
Yeah, thanks, Chris. It's been a pleasure to be here.